Standard deviation is a core concept for understanding investment risk. It measures how much an asset's price swings away from its average return. In finance, we use standard deviation as a proxy for volatility. It tells us how predictable or wild an investment might behave over time. You will often see the lowercase Greek letter sigma used in formulas. It represents the standard deviation of a dataset. A low number suggests returns stay close to the average, while a high number indicates wider, more unpredictable price swings. Comparing assets with different deviations helps investors understand the range of potential outcomes they might face when holding that investment. This chart illustrates how different asset classes typically exhibit varying levels of volatility. Higher numbers mean more deviation from the average return. Remember that while this formula is a powerful tool for analyzing history, it cannot guarantee how an investment will behave tomorrow. Understanding these metrics helps you build an informed portfolio. Check back for more finance basics, educational content, not financial advice.